Hi guys, in the last few videos I've talked about why I prefer rules over emotion, why markets don't behave in neat predictable ways, and how I structure things operationally. So the next natural question is, if we're going to invest systematically, what type of systematic approach are we going to use? Because not all rule-based portfolios behave in the same way. Some are relatively steady and slow moving, whereas others are more adaptive and responsive. And really understanding that difference is important before we dive into the specifics of each strategy. So let's start with static systematic investing. Static doesn't mean lazy, but it doesn't necessarily mean passive in the traditional sense. It simply means the system doesn't change very often. For example, you might build a portfolio that owns a diversified group of ETFs. It tilts towards certain factors like value or momentum, and it rebalances once or twice per year. The rules are still there. It's systematic, but the system isn't reacting aggressively to short-term market movements. It's allowing long-term drivers to do the heavy lifting. And the philosophy behind this approach is fairly simple. Markets tend to rise over time. Certain factors have historically delivered excess returns. Compounding works if you give it the time. So the system's job isn't to predict every move. It's to stay consistently exposed to long-term return drivers in a disciplined way. So the trade-off, you might ask? You will experience drawdowns. You will sit through bear markets. You're not trying to avoid every crash. You're trying to capture long-term risk premia efficiently and consistently. And this type of system often suits investors who prefer simplicity. They don't want to trade frequently, are comfortable thinking in multi-year time horizons, and can tolerate a little bit of volatility without interfering. It's systematic, but it operates slowly. Now let's contrast that with a more active systematic approach. Here, the system makes more frequent decisions. So examples might include monthly momentum rotation, trend following using moving averages or breakouts, tactical mean reversion strategies, sector rotation. The rules are still rules, but they respond more often to changes in price behavior. For example, if the market drops below its long-term moving average, the system might reduce its exposure. If certain stocks or sectors show relative strength, the system may rotate capital towards them. If volatility changes significantly, exposure might adjust. The philosophy here is slightly different. Instead of simply harvesting long-term exposure, you're attempting to improve risk-adjusted returns, potentially reduce drawdowns, and allocate capital based on evidence. But there are trade-offs here too. You can have more turnover, more decision points, and more potential for whipsaws. An active system might avoid a large crash very effectively, but it might also get shaken out during noisy sideways markets. So it's not automatically better, it's just designed to behave differently. So here's the key point. Both static and active approaches can be systematic, evidence-based, disciplined, emotion-free. But the real difference is, how much decision-making do you want the system to do? A static portfolio makes fewer decisions. It says, stay broadly exposed, rebalance occasionally, and trust the long-term drivers, where an active system makes more decisions. It says, conditions change, let's adapt when the evidence shifts. Neither is right or wrong, but they require different expectations. If you're deeply uncomfortable during drawdowns, a pure static approach may feel psychologically difficult. If you dislike trading activity and complexity, a more active rotational system may feel overwhelming. It isn't just about the performance, it's about alignment between the system and the investor. If you were to look at the equity curve of a static portfolio, you might see steady term growth, but with significant drawdowns during major bear markets. But if you were to look at an active trend following system, you might see smoother behavior during large crashes, but potentially more short-term noise. They just reflect different philosophies of exposure and adaptation. And once you understand that distinction, evaluating strategies becomes a lot clearer. So me personally, I tend to blend different approaches. I like having some strategies that are structurally exposed to long-term drivers and others that are more dynamic and responsive. Because as we know, markets go through different regimes. Sometimes trends dominate and sometimes mean reversion dominates. And sometimes even broad exposure works best. Remember that different systematic approaches behave differently across those environments. And when you combine them thoughtfully, they can complement each other. But portfolio construction is a much deeper topic and one we'll explore more as we move forward. So as we advance into more videos and specific strategies, I want to clarify this distinction because when you see systematic portfolios, including mine, it's important to understand what category they fall into. Are they designed to sit steadily and compound or adapt and rotate? Both are systematic. Both remove emotion. They simply operate at different speeds. And understanding that will make everything we cover next much clearer. Thanks for watching, and I'll see you in the next one.